I'll give a quick liner. Santosh, he's the guy who actually, for me, the stagnation to explosive growth guy, I would call him. He's done that at Apollo, he's done that at Zoom Info, now with retention as well. I think you never stagnated. Obviously, been at explosive growth throughout. Amit, you sold your company to HubSpot, and you've been building a company which was also a lean team to begin with. Now you're on the VC side because you've been a founder. Now you understand what the founders need. And I read on your website that see a lot more VCs that would be founders, ex-founders, and that's something that very interesting. And I think I see a lot of trend, but I want to hear more about that. But again, you can start alphabetically by how your pin journey been, and what is that one thing if you would change at all, what would that be?
So yeah, I'll keep it really short. So yeah, I think probably the most important part of my career has been being one of the co-founders of Clearbit, which, as you mentioned, we had very fortunate to have an acquisition to HubSpot last year. We started the company in 2015. The goal originally was to basically be Stripe for data. My co-founder Alex McCaw, who's our CEO, he's one of the first few engineers at Stripe. We just felt like data companies at that time, things have changed a lot in the last 9 years, but at that time, we felt like data companies were decidedly um, not very modern and old school, and they weren't kind of API first. And there's a lot of automation we saw happening in marketing and sales, and we just felt like there was an obvious opportunity there. And we'd independently worked with a lot of old school data sets from like Dun and Bradstreet and other things. And Yeah, so that was something that again, before that I had been at startups as an early employee. That was the first time co-founding something. And then a couple of years ago, I actually fired myself, uh, as did Alex. Prior to the acquisition, I think we were more so 0 to 10 guys, and both his side on the product side, and me on the go-to-market side. I was our CRO for the first 6.5 years, which is usually longer than most CROs last, but I guess we put up good numbers. But ultimately, I realized that I wasn't scaling as well. At that point, I had over 100 people in my org. Yeah, through kind of a series of serendipitous connections, including some of our early investors in Clearbit, had a chance to raise a small fund. We always felt like, we always got annoyed when there'd be VCs who like would be very interested in Clearbit and they didn't know how to use the APIs. And it's just like, what are we even talking about here? And
Yeah.
it didn't make sense to us why a lot of VCs, it makes a little bit more sense to me now, but we just felt like, why aren't more founders and builders doing this? It's actually not that hard to do. Like the earned uh, information you get from actually going through it and the network you get, all the things that make VCs good, you actually probably get more as a builder than you as a VC. So for us, it made sense to explore doing, and we'd done some angel investing, and then we had a chance to launch a small fund. Naval Ravikant and Jeff Fagnan basically anchored us. So we said,
Mm-hmm.
okay, it's fairly easy to do. AngelList basically is like AWS for funds. It's like much, we don't have to sit there and do a ton of administrative stuff all day. We can just spend time paying forward things we've learned and obviously trying to long term make money along the way. So yeah, we did first fund and now doing a second fund. And I actually love doing it way more than I thought I would. And so here we are. It's called Earl Grey Capital.
Yeah. Anything you would change in that journey?
Oh yeah. I mean, the number one thing, like 1A, 1B, and 1C, was we would have gotten better at figuring out churn and retention at Clearbit. I mean, that's there's a lot of other stuff, but that is like, I'm
Mm-hmm.
on an island somewhere if we figure that out. So,
Mm-hmm.
that was just, something that we had so much growth and inbound growth
Yeah.
and net and even positive net dollar retention despite
Mm-hmm.
that. Um,
Yeah.
but ultimately it's exactly as advertised. It's just it sinks you over time, in every way, shape, or form. And to give you a frame of reference, I mean, we sold the company at 40, 50-ish million ARR. I think we probably sold over the life of the company over 100. And so when you put that in perspective, it's like, wow, how much running uphill do you have to do if
Yeah.
we didn't get that right much earlier on? And again, we did a lot to prove things over time, but in my opinion, not enough.
Got it. So would have worked on the churn better if you got a chance to. Santosh, what about you? You were smiling when he was talking about churn.
Yeah, no, that's everybody has their own scars and stories around churn. But back to just my story. I think my career pivoted when I ran my own business right after business school. And at that time, I really wanted to do a quick flip. My goal in life was to sell the company within a year or two of starting, so I could get some money and pay my business school loans and so on, which I did, which I'm proud of. We were able to start the company, take a seed investment, and sell the business to Nuance, which is now owned by Microsoft within 2 years. And
Okay.
everybody went back
Mm.
happy. But after that, what I realized is I really loved starting and exiting a business, but I hadn't scaled it as much. I saw all these unicorns and billion-dollar companies, and they looked overwhelming.
Hmm.
So this is where my journey started into growth. And over the next decade, decade and a half, I realized it's not that difficult to create a unicorn very intentionally.
Hmm.
Uh, as long as you have the right team and right, you select the right market and so on. But operationally, it's not at all difficult. If you create, there are some, traits that go, you need to create network effects and flywheels. And there are other ways to kind of make it simpler, which a lot of founders ignore. But if you put that in place, so venture after venture, I've seen, the biggest enemy of these companies are the founders and the founding team themselves. They are the asset, but they are the risk, right? And if they get this right, it's like everything in nature wants to grow, right? A plant wants
Yeah.
to grow, right? And the only reason it doesn't is because you artificially constrain the grow, right? So every business starts with a great idea, and then
Yeah.
the founders are constraining the growth through their own DNA. And over time, I got really good at picking this up and nurturing the talents and strengths. And I've seen many businesses, including some of the ones you mentioned, but even others that I've advised over my career that went on to become really big. You asked one thing I would do different in my career.
Yeah.
And I was thinking back, the reason I like the growth stage is because I feel like that's when the best of human potential shows up. I see every team
Hmm.
member like doing their best, right? And they're excited. And I like surrounded by people or living in an environment where everybody's doing the best they can without worrying
Mm.
about the future, right? And that only
Yeah.
comes from abundance, from when you are like immensely successful.
Yeah.
And my regret would be that when I look back in my career, I have tried to, I wish I would have spent more time in those environments that were already turning out to be successful versus times when I was banging my head on the wall and nothing was going to change. And I still thought, let me spend another 6 months, another 12 months trying to uh, turn things around. And it still doesn't, right? So, but moving forward, life's short. All of us should
Yeah.
do what's where you can be most effective.
Yeah.
But those are lessons I try to apply as I take on
Awesome.
new
I
opportunities.
think the regret answer Amit was hearing and wanted to hear was joining his board. That's one of the regret.
Oh, I mean, I've been an admirer of others for a long time, and I wanted him to join Clearbit's board. I tried a few times internally, but it was totally on us. We weren't able
Okay.
to do it. That was because I think we were probably a little worried that he was involved in competition and other things like that. But, I mean, he's a N of one when it comes to scaling at that level. So, we definitely could have used some of that.
Yeah, yeah, for sure. Santosh can be on board of already a lot of companies, and I can see why. Santosh, I think let's talk about that. Growth stack. That's the first thing that got me to talk to you. You mentioned that this kind of growth, the one that you have at retention or even at our B2B is even more phenomenal. For somebody watching this and can take this back. what is a good stack like, to use? And if you can give away your stack, that'd be amazing too. Like, what is it like?
My response is going to be very counterintuitive because um, most companies that are part of that have been very high growth, you'd be surprised how frugal the stack is.
Yeah.
In terms of like tool stack. Um,
Mm-hmm.
so at retention, we barely use any tools. I mean, other than the usual, the CRMs, and we don't do outbound email the way you would think. So we don't have like Salesloft type license. We don't use any of those analytics tools. And when I look back or think back about like Zoom Info or some of the other companies I've been part of, at this stage when they were growing wildly, they didn't use too much tool either. I think it goes with just the culture of ultimately efficiency comes all around, not just so when you're in an efficient environment, you get so good at building these tools, and in a way, you are breaking the laws of nature, right? So we do, of course, have systems in place, right? A
Yeah.
lot of those systems are homegrown, and then we try to recreate how we do go to market. For instance, we don't use like we try trade events, right? And in a typical trade event, we are one of the 200 other companies participating. Nobody pays
Yeah.
attention to us, right? So
Yeah.
now we created our own event. So like today, there's an event going on called Retention Retalks, and there are hundreds of like marketers that come, and it's our event. So obviously, we get a lot of attention, and then
Yeah.
we found a way to manage this, and rather than be part of something else where we'll not get the right attention, right? We are turning into a bit of a media company. I think future of SaaS sales is every company try to like grab as much attention as you can.
Mm-hmm.
And in the process, we have built a lot of systems, but a lot of them are homegrown, or we use agencies and external contractors or advisors
Yeah.
rather than a lot of tools
But
or SaaS tools.
but I hope you're using Zoom Info and Apollo in your mix.
uh,
Tough one
we,
to ask, right?
yeah, tough one to
Sorry.
answer because we are building our own database as well.
Okay, okay. No, no. And also, give me something that they should take back. I know you're saying you do your own frameworks and everything. Tell us one thing that you're using that people can take back. You know, even if it's just one thing, any tool or anything, any framework that you built, probably that you can give away in a short answer.
So there are several frameworks. Um, uh, like I said, we use a lot of proprietary tools, but I'll give you a framework that every time if somebody launches a product, um, so I'll share how we launched our B2B, and
Yeah,
it was super successful. We went
yeah,
from nobody knowing us, which obviously it's a new product in a crowded marketplace, nobody knows us, right? And
yeah.
within 6 months, we have 20,000 accounts signed up, right? And I have been part of many, many, many product launches, and I've gone through this where you launch a product and like 6 months later, you barely have hundreds of people using it. And so what we did is I started writing on LinkedIn because of our
Hmm.
B2B launch. So like 2 months before we were going to launch, right?
Yeah,
And then every time I write on LinkedIn, there is this period of 24 hours where people uh, are you get like a slight micro celebrity status if that's a way to say it, right? And then they quickly
yeah.
forget that post, right? But then
Correct.
within that 24 hours, if I drop a message with a calendar invite saying, "Hey, can I show you something I'm working on for 15 minutes?" Right? They're likely to like respond. Like there's a very high conversion, whether me
Yeah.
or Adam.
So is it to
So
people who have engaged with your content, you're saying? You send the message to
right,
them?
right, yeah.
If they've
So we
liked or
built a
commented anything. Yeah.
Right.
Okay.
So we built this tool, automation, um, 6 weeks before we launched the product. We built
Hmm.
this automation where we were just writing content. This automation would go check likes and comments every hour. and
Yeah.
then scrub it against our ICP
Yeah.
to see if they were like relevant people that we should, and then drop a calendar link with a message saying,
Nice.
"Hey, can I get it?" So it turned out that I blocked in my calendar like 4 hours every afternoon for like 6 weeks,
Yeah.
and then my calendar started filling up like every day.
Yeah.
And I would only do 15 to 20 minutes call, and
Yeah.
in those 6 weeks, believe it or not, I did 250 calls, all
Wow.
with VP and above, right?
Yeah.
All with decision makers. And those calls, I was not selling. I was just talking to them, right? And giving
Yeah.
like generating credibility. And
Absolutely.
but you create brand face to
Yeah.
face. Companies, you can't create brand with a company. You have to create brand with an individual and preferably with a founder or exec, right?
Yeah.
Um, so by the time we launched this product, I had spoken to 250, 300 people, and I had a waiting list of 3,000, right? So we started with such a bang
Yeah.
that lifted us, and that's a playbook anybody can follow.
Yeah, yeah. No, thanks for sharing that. In fact, I'm gonna do that too. You'll be surprised how many people are still doing it manually, what you just told. I bet there are tools as well. I know you built it yourself, but there should be tools out there who can do this, right?
Sure.
Send an automated message. But that's a great learning for a lot of people who can use these tools to hack the growth, right? In this new growth economy that we are living in. Thank you, Santosh. That was
So
very
since since
inspiring.
you since you asked for a tool,
Yeah,
uh, I will say any tool that gives you signals
yeah,
is very relevant and then helps you act upon the signals. And there are many tools out there. We use Clay internally. They give
yeah,
us access to a lot of signals and then help us execute on it.
yeah.
There are other tools like that, especially Common Room and a few others. But
Yeah,
those are good ones for people to look at. And there are many coming up like
yeah,
every month
yeah.
in this
No,
space.
okay. Good to know. Noted it down. Play. Awesome. Amit, you need to better that now. So when you were building Clearbit, what is that one or maybe a stack or maybe that one tool you can give away and that really worked for you?
Yeah, I think we also didn't just go and buy and use every kind of hot SaaS product we saw. We also were pretty deliberate with, okay, what's our go-to-market strategy? Where can we get leverage? What are we trying to do? Now, we were certainly, because we were like, you know, go-to-market nerds ourselves, we definitely did like to jump on like, oh, let's automate this or let's use data here. We did a lot with Segment, so we'd pipe data in and out from every dimension, whether it was customer usage, sales interactions. Like I would take everything in Salesforce and we'd pipe it into databases, into like Redshift databases via Segment.
Hmm.
At the time, now it's very common. It's like, oh, AI tools transcribe everything, but we were doing all that way before it was as common. So we'd pipe everything in from every system, and then we could do really creative stuff with, like a customer IO or with ads or with whatever. So we kind of ingest data from, and again, this is a lot more common now, but certainly in 2015, 16, 17, we were pretty sophisticated to be doing all that, especially because, we had to probably build more of this ourselves. I think pretty innovative in doing a lot of that. And, we did some really creative stuff. I don't know if they like, we had like fully automated outbound sequences that looked very real and they would be highly customized. I actually don't think those drove as much revenue as they were kind of cool and had sex appeal.
Yeah,
Really, but like they certainly were cool and they inspired ideas that customers would want to do and things like that, which is part of our brand and part of our value. So yeah, I'd say kind of more the data automation and ETL that enables you to do more creative stuff in the off-the-shelf marketing and sales tools. I think we were pretty fast to adopt.
yeah. And you guys are big on data and you sort of again like Santosh building it a lot of those things in house too, right? Because you understood the value of data because that's the value prop was for the other marketers, right? Eventually you were selling it to the marketers too.
Yeah, although I'll say this though, like, while we didn't have amazing RevOps systems, they certainly got better over time. But yeah, I think we were pretty creative with the stacks we used to run the company. Probably overcomplicated them in some ways. But it was fun and it was energizing and it again, I think clearly much of the market has moved to do that through SaaS
Yeah.
now early on that. But I would say no question that the biggest source of like what drove you know, tons of inbound, tons of everything else, more than anything else, whether systems or automation or anything else, um, was really just,
The product.
word of mouth. Yeah, product, word of
Yeah,
mouth.
yeah, yeah,
We were very clever at doubling down on that. So we were very good at like, okay,
yeah,
well, people are doing something creative with marketing, and other marketers see that, and they're like, I want to do that too. So
yeah,
I actually wish we probably should have done more of it, but organically, we'd have customers want to sort of achieve kind of, again, status or show off creative things they're doing that then others
yeah,
are required to do. And that really kind of compounds at scale. And we had a lot of free products as well that helped drive a lot of awareness and trust and traffic.
yeah,
Yeah, I'd say it's a combination of those things that really led us to be, and
yeah,
we're pretty clever about, pricing and things as well. Again, I'd say we got less clever over time, and I'm definitely responsible for that. But early on, we were very
yeah,
smart, kind of like, we look cheap, we're easy, but we're actually closing you on a 30K, 50K deal in a high
yeah,
efficient kind of, so it's like a perfect blend of self-serve and sales where we do sales hyper efficiently, instead of having people walk away with, really small contracts. But we can probably get into this more. I don't know if that would work today, but
yeah.
it worked then.
No, for sure. I think what I'm hearing
So
is that you don't need a lot of tools to do growth hacking from both of you.
that's right. That's right.
So as
Hey,
much
Ahmed,
as
I'll say this
I,
though, and you know, you don't necessarily need tools, but I do
yeah,
think founders and go-to-market leaders should think in systems of like, okay,
Mhm.
not like buying a SaaS product is not going to replace systems thinking, but it is smart to think about leverage systems, like how's this going to work? How will this work if we have 50 leads versus 5,000? And like, you don't want to over-architect if you don't have product market fit, but
yeah,
I do think there's a lot of validity, especially in the age of like, how can you do more with less and be more automated and have more leverage? It is
yeah,
important to think about the sort of go-to-market system, um, as a product, as something that, but how you do that is sort of unique to you, right? So do you have multiple products? Are you inbound? Are you self-serve? Are you enterprise?
yeah,
The way you do that is different. But I do think there's a lot of value in thinking through that and where your advantages are going to be sooner rather than
yeah,
later. Sometimes the answer is that SaaS is more SaaS. Sometimes it's do it yourself. Sometimes it's, other things. But certainly I come across a lot of founders who don't give it enough attention, and they should, because it is going to help them quite a bit.
Totally,
yeah,
totally. Hey, Ahmed, as you were mentioning about Clearbit, I realized something. Um, some of the data companies I've been part of really benefited from programmatic SEOs,
Yeah.
right from the Zoom Info days, right? But I never noticed Clearbit doing programmatic SEO as effectively. What was the reason? That was probably a low-hanging fruit.
It's interesting. I actually thought we actually did a lot with SEO. Maybe we weren't
Oh, you
as
did?
yeah, I mean,
Nice.
well, yes, we definitely did a fair bit of SEO. I'll give you an example.
Hmm.
At the time, and this is Matt Sorensen, who eventually took over CEO, and he's the one who actually guided us through the acquisition, and he's now at HubSpot. He was pretty early on this. Yeah, I don't know if we just were like, I don't think if we're excellent at SEO, but we did some pretty creative stuff. I don't know if you guys remember listicles. Those were
Yeah, yeah,
like
yeah,
yeah. I
hot
think,
fire. So those are things where we would actually pay. I mean, at one point, Matt was running marketing, and it was just him and 19 contractors. So he
right.
had this is early, obviously, but we do some pretty creative stuff with like having tons of long tail content created where like we don't actually care if this gets found, we just care if it gets indexed. And we don't even care
yeah,
if it's number one on that list, but we would basically pay people to generate large amounts of those types of content where, we'd actually be kind of behind it, but it was all for SEO, and but we didn't have a lot of like, we could have, for example, had millions of company pages and
Yeah,
then
yeah, yeah. So that's what I meant
yeah,
by
we
programmatic
didn't do
SEOs.
that. We probably
But
should have.
yeah, Clearbit was really good. I remember now that you say on the long tail, like content SEO,
Right.
right? Whereas Zoom Info and Apollo and others were good with publishing all these pages with programmatic SEOs.
Which is smart. And by the way, I've now seen some startups that basically do that. Like that's the startup. It's like do programmatic
Mhm.
SEO,
Right.
which I think
yeah,
is interesting. And then I met a company yesterday who's doing AEO, which is answer engine optimization. And they're
Oh, nice.
Right. So
Yeah,
for for Perplexity and ChatGPT, it's
right,
like
right.
up there. So definitely there's I think programmatic with a capital P is how people are thinking about SEO and AEO going forward. And it'll be
Yeah, yeah.
out.
I see a lot of founders, they want to go on Twitter because all the VCs are there. So everybody's told, hey, you need to get on Twitter. You need to get your Twitter game on because all the VCs are over there. What are you doing on other formats? So I don't know how true is that now, but yeah, I mean, a year ago, I see a lot of chat around that.
Yeah, I mean, look, I can speak from, I guess, both standpoints. I think on one hand, I have a reaction of like, okay, that's silly. You should be spending more time where customers and users are. If they're going to be there, great. But kind of optimizing your brand and attention for VCs is
Right.
not the smartest way to run your company, honestly. That said, um, it does work. I mean, I see all the time. You take company
Yeah.
A and all things created equal, let's say the numbers are good, not great. Let's say what they're doing is good. They're in a space that maybe is, not so differentiated, but one has a founder who is great at playing the attention game or great at building brand and even just unrelated to the company, they will get more bias from VCs. Absolutely. They will get kind of there's sort of an implicit idea of like, oh, if they have 100,000 followers, I trust them more or I'm impressed by them more than if they don't, which again, if you look closely, it's kind of silly because there's some of the best people in the world who have like actually great at actually building stuff who have 1,000 followers, whereas some who have 100,000 who are just like playing the game. So it's inherently irrational, but it makes sense though too why people would bias to that.
Yeah, I think
Yeah,
you mentioned in, sorry, go ahead, Santosh.
no, I was just going to add, this may be a little complex to share, but there was this economist that came up with this idea that whenever there is, asymmetry of information between buyers and sellers, it gives rise to bad actors getting rewarded and good actors quitting the market, right? So this guy's name, he got a Nobel Prize for this economic theory, George Akerlof. And you can
Interesting.
apply this to what just Amit said on Twitter,
Yeah.
right? Because some entrepreneurs or founders that create hype, they would get rewarded for this information asymmetry because clearly there's a not every VC will know all founders out there, right? And
Yeah.
and then some good founders that are focusing on customers may actually get punished and eventually quit the market, right? And then there'll be more and more founders that are only focusing on hype and not on building a real business because that's
Right.
what's getting rewarded.
Yeah. I think signals over data. I think you talked about that in one of your chat together, right? So completely makes sense now, and nothing to be. There's nobody's fault. It's just that you have less time. If you keep hearing from one person more, you just
Right.
get his attention better than the other person who might be building something better. So I think that's the world we're living in. I was just checking, just before the podcast shoot that hey, some of my VC friends like, API first, is it even happening? Why is it not happening? So got some good observation by some people. I don't know how much you guys are familiar right now with the Indian ecosystem, but like one guy told me, India is a small market unless it's financial services for this. There's somebody building in this space, but they're building for US from India, so it's very different. So, uh, any thoughts there, Amit? I mean, API first, if you can tell us what are these
Yeah.
companies? The name is very intuitive, but you are investing heavily in those. So, tell us more about that.
Yeah, so when we say we invest in API first companies, it really means two types of things. One is like OpenAI, right? It's like you're a company that has built an incredible technology behind the scenes, uh, but you are now making that technology available to others to build on top of. Think of the number of companies that are now built on any foundational model API. Think of the number of basically new products, features, ideas so we love companies that basically enable a lot of other people to build on. And it's a critical part of maybe the entire product, maybe it's just a piece, but either way, it's like, oh, this technology now made easy for you to use is a major
Yeah.
driver of value. And then the second category is more like Stripe, like Clearbit, where it's like, okay, there's a lot of stuff that, you know, this would be very hard for you to do on your own, but you kind of need it, right? And in Clearbit's case, it was, basically data and a lot of the work behind the scenes for that.
Is this something that, is what you're talking about as well? Would it be called API first as well?
I sure do. Yeah, I think it would. And my question would be, and again, not to criticize because it looks really cool, but yeah, my question would be, is this something that companies wouldn't want to do themselves, and why not?
Yeah.
That said, I think you've seen a lot of kind of integration aggregators do very well, whether it's everybody from MuleSoft to Tray to Merge API. I mean, there's a lot of market there, and certainly. At a very, obvious level, it's like, yeah, of course, I'd rather use an API to connect with 50 other integrations or not have to build this long tail. Like at Clearbit, we built a Salesforce, HubSpot, and
Yeah.
like integrations. Whereas if there's 50,000 other tools, we were not going to build them all and maintain them all. That said, though, what happens to pricing power at scale? Like if that gets expensive, you're like, well, I am going to
Yeah.
build it myself, right? And that's
Yeah.
where with Stripe, you can't. Whereas with this, could you, right? So, but I
Yeah.
think it's an awesome company and a major market. But those are the types of things I ask myself when looking at companies.
Can I respond to something you asked Amit earlier
Yeah. Yeah.
about the
Sure.
Indian entrepreneurs or ecosystem?
Yeah.
I do think there's a massive opportunity
Hmm.
waiting to be unlocked by the Indian entrepreneurial ecosystem that may
Hmm.
not be so apparent, right? So the what we see in general, not just in US, is we are going to begin to see 10 people unicorns, right? The cost of building companies has gone down. And one of the reason you saw so much innovation in the US is because capital was easily available, right? But now that capital is not the biggest barrier to growth because of APIs, because of automation, and it just becoming easier to build systems. Buyers are interconnected; is becoming easier to sell. So you're going to see more unicorns overseas because of this, right? Because you have now less availability of capital. Could also somebody sitting in Bangalore with 20-person team can dream of building a $1 billion SaaS tool.
Yeah.
Um, so all you need is a healthy dose of ambition. I'm sure there's
Yeah.
talent.
No, but that's
So
why they're coming to US to raise money, right? And I see a lot of SaaS companies founders traveling to US for the GTM. And I saw a very interesting meme the other day. Now they're traveling back for the IPO in India. So it's a good time to now raise, your IPOs going public in India right now. So
Yeah,
that's
totally.
one trend we should talk about. I think, Santosh, you briefly touched upon that, right?
I'd actually love your
yeah,
opinion on this. Dave. From my standpoint, my family lives in India. We've invested in a handful of Indian companies, but probably most of what we do is still um, eh, broadly still more US. I'm actually always surprised that there aren't more
mhm,
great Indian companies that have gone and built technology that everybody around the world uses, like a Zoho
Yeah.
or Freshworks, but there's like not
right,
that many. It doesn't actually make sense.
right.
Why? Because like everything Santosh said, first of all, just as far as the Indian economy goes, it's like, man, what an incredible. I think India may be better positioned than every other country. It has
Yeah,
more
totally.
people who are building and just this, sheer talent density. But it surprises me. And there's actually been some pretty big flameouts, some embarrassing ones. There's some big
Yeah.
multi-million dollar
Yeah.
companies that were either fraudulent or otherwise. So I actually would be very curious, like, why aren't there more great SaaS companies? And forget venture for a second. Why aren't there just more great companies
Yeah.
that build stuff that the world uses? Because you don't have to be in the US to do it at all.
Yeah,
Totally.
I mean, I think one reason that's top of the mind is because there are not a lot of consumers for SaaS, right? It's very hard to sell SaaS to Indian B2B companies. I mean, they're just very used to the hands-on service-based approach. Things are changing. I'm not saying it's not changing, but that's one thing that we've been a little late to get onto the SaaS bandwagon as other companies. A lot of great companies now building from India, going there, and probably they will become a unicorn soon. They're a little late to the to the whole US scene, but I think that adoption of companies inside India, which makes it a little harder initially. When you're building, you can build for US. There's no doubt about that. But building around you can give you a lot more learnings. Can do a lot more for you when you're building, especially you're aiming to do a unicorn. That's at least one view that I have. Santosh?
So there is also a little bit of data issue, Amit, because what happens is if a company starts becoming successful in Bangalore, and like Chetan said, they don't have enough customers in India, right? So then if
Yeah.
your customers are in US, very quickly they open an office in US, and then we see them as a US company, right?
Yeah.
We no longer see them as Indian headquartered company, right? So there may be a ton of US Bay Area venture that actually got started in India, which we are
Yeah.
considering as US, and then they raise Series A and Series B in US rather than in India, and then 90% of the team may still be in India.
Right. No, it's just interesting. Yeah, I mean, fast forward the next few years, let's assume there's a massive number of, small SMB or bootstrapped or otherwise just software company.
Right.
If you're selling, instead of fighting tooth and nail of the Fortune 500 in the US of
Right.
$19 a month product to those companies, again, look at Zoho, look at Freshworks.
Yeah.
Yeah.
Why wouldn't you?
Yeah,
Right?
I think it's totally going to happen, right? They just it's like small teams. There's so much of pricing pressure at the top, right? And then the economics don't work out to kind of sell at $10 and $20
Yeah.
a month unless you are based overseas, right? And with
Yeah.
small team, and so you will see now a lot of those companies will also move over to the US.
It's like, look, Europe is not a innovation friendly state, right? It's
Yeah,
very like you should leave just culturally if you want to start a company because it's so hard to do things there and employ people, this, that. Whereas India is very innovation first. And that's why I'm kind of just like, oh,
Yeah.
why it's part of the
And
culture. And I'm like, yeah, there should be more great companies from India
correct.
that's India
And
and India.
one thing you'll be surprised, and I mean, you may be knowing already that I was reading a report, and this was also talking to a AI company that's at a Series A, and they were, we were making a deck for them to pitch to NVIDIA board. One thing that came out from the research was that Indian companies are going to leapfrog the whole SaaS thing and get faster at AI adoption than a lot more other companies, which makes a lot of sense now because I'm seeing a lot more adoption of AI, even if it's not SaaS. But that way, they're at least paying, as a SaaS. So slowly, they're seeing the value in AI, if not the product, and then probably they'll start paying it as a SaaS. So I mean, that's one trend to look for. I would definitely say, that just leapfrogging the whole thing and just going straight to more AI adoption.
Sure.
Awesome. So I think it's
yeah.
now time. Yeah, Santosh, anything to conclude that? I know we've talked about RevOps,
Yeah.
that got
So just
digressed.
quickly, yeah, RevOps. I think that's one of the most important like department or teams in any company that gets overlooked if you are like early in the journey, right? Um, I mean, it's important to sort of manage unit economy, know the variables like almost week to week, right? That impact your larger businesses and that align with the KPIs or metrics, so you know what to achieve. And most businesses they look at revenue
Mm-hmm.
as like a goal, which is like there's many variables that contribute to revenue, right? And that needs to be optimized in order to have a healthy revenue or so on, right? Um, I I think, and then you need systems, or whether it's homegrown or you buy those systems. In our case, we do like a weekly staff meetings where we go through these metrics for each department that can contribute to what we define as healthy business. Um, I think increasingly in future, the metric that every business will care about is revenue per employee, right? Which because efficiency, that's probably a most uh, single metric that I can think of that reflects the efficiency of the business, or the how strong the business model is, right? Or how sustainable. But there are other metrics that fall from it. But RevOps, it doesn't matter. RevOps is just a word,
Yeah.
but these systems or these metrics need to be tracked very frequently in every company.
Revenue per employee. Yeah. Yeah. That's super critical, right? I mean, people don't think like that. Like, there are a lot of companies or agencies, they don't think like that. I think it's a mindset too, to think like
Mhm.
that, and RevOps can probably, if you start focusing there and start measuring that metric, I think it's going to take care of everything else. It's safe to say,
Right.
right? If you take care of that metric. Awesome. Now, good to know that, Santosh, because you did mention, and right now even Amit mentions, I thought we should take your views on that. Great. So now we are at that segment that, we talked about it really at the start, and that was the segment of actually doing a reverse pitch. And, now you should leave all that friendly vibes aside. And, of course, Amit will make a point why you should take money. And, you would probably, then talk back why you don't need money, or for what reason you may get convinced to take money. Who knows? So, Amit, I think you should go first. I mean, retention, and if you don't know, you can ask him. But yes, you should talk about that. And just to keep it fun, we can, focus on just retention, and, like you're asking that, hey, why don't you take our money? We are the right kind of people to get you your next growth.
Yeah, I would say, for a company like retention, I think the number one argument would be, to take venture money and take a lot of it, is just to look at precedent. And yes, things may change forward looking at AI, but historically speaking, if you look in big MarTech and SaaS, I mean, the companies that have gone the distance to an IPO, which really is, and maybe I know too much about retention.com, but the companies that have actually gone the distance and built something durable that ends up making a lot of people, and shareholders aren't just investors, right? It's employees, it's future employees. There's a lot of people at stake here whose careers and lives depend on it. The ones who get to the point where world changing and life changing, money comes from is at that level. It's not the companies who are kind of in that, 10 to 30 million, 10 to $50 million ARR business. Maybe there's M&A, maybe there's not, but it's very unpredictable. And so those companies are, fair or not, the ones who've typically raised and raised more and have gotten to the promised land. And it's not to say that it's, it's maybe probably more correlation than causation. But the reality is, in a crowded market, which undoubtedly MarTech is, um, those things matter for everything from hiring top talent to compounding advantages to getting brand and attention. And it's not to say that money alone is necessary for that, but if you were to ask yourself, hey, we want to bring on top people or invest in other things that are bigger swings, even with product, especially as things get more competitive. If you're thinking about profit over those things, you're ultimately going to kneecap yourself towards that vision, which, based on the current markets, is really the only way to generate significant liquidity. So if you have hundreds of employees and others, you should be shooting for the stars, because if you're not, what are you doing, right? Like it's not the right thing to do. And then lastly, there's an argument to be made that, and again, I say this a little bit tongue in cheek, but there is an argument to be made that, like, the right investors, and I'd I'd say categorically VCs represent themselves here, but with the right investors, like, look, if HubSpot's going to buy retention, maybe it makes sense to let HubSpot invest in the company. And there are investors where, the reality is a lot of big deals that happen behind the scenes, they are network based and relationship based and emotionally based as well as they are practical. So is there a world in which, think of it like a sports team, can you add great players, great talent, great brand to the company? Now, accomplished people aren't going to want to do it for free. They want a financial interest. They're going to want to invest or have some sort of reason to do that. So I'd say, kind of to summarize, it's like, can you add to the roster because you're playing to win? right? Are you playing to win? Clearly, retention is because you're growing fast and you care. It's extremely crowded. So, should you be investing in those resources to keep your pace because it can go away like that? And then third, what about again, like the pie, to make the pie bigger is the only way everybody wins. Otherwise, usually only the founders win.
Yeah, that's
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 awesome.
that's very convincing. But
I don't,
let
I don't, I
me,
don't believe, I don't
but
believe at least 40% of that I don't believe, but I figured I'd hit.
but here are um, here are the parts that I really like and agree, and then I'll get to the parts that I have challenge accepting. So I do like strategic investments that you mentioned, right? A lot of the deals do happen through networking, right? So whether directly or indirectly or later on, if the example you gave, say HubSpot wants to buy, they'll likely invest. Flirt before they end up buying, right? By staying away from that investment, we are reducing that possibility, which as any company, we do want to get acquired eventually, right? So that's a strong point. But let me go back to, and this is the struggle that all bootstrap companies probably face, right? Is we do want to grow, and we are growing, and we are not early stage in the as early stage in the sense we are profitable, right? So the worry is there's only 5% companies that will go on to IPO and make it big, right? Or very small percentage, right? So likelihood that if we go on that path and we don't end up making it big, we lose the opportunity that we have at hand, where instead of looking for a big liquidity that may or may not happen, the likelihood just decreases. Um,
Yeah.
at least we have the option of doing micro liquidity or kind of keep growing along the way. Somebody said recently that the valuation growth momentum, and I love your perspective, Amit. So the growth contributes like several times to valuation than profitability,
Yeah.
right? Which is for the VCs, that kind of makes total sense, right? But for bootstrap founders, profitability matters several times more than growth, right? Because that's something they can bank like today rather than wait for 6 years from now, which may not happen, right? Likelihood is lower. Now, if we were 2 million in revenue, 3 million in revenue, it would be very different than when we are 25 million in revenue.
Right. If you're making 3 million in revenue and you wanted to keep two of that, that is not a company that
That's not, yeah,
would not want to work there, right? Or
right.
you wouldn't be able to, again, that could be great for the founder, but at that point, that's not an attractive
Yeah,
investment.
totally.
Yeah,
Totally.
I think the challenge here is that he's convinced that he wants to see the liquidity, the medium liquidity, and of course you, Amit, on your part, you want them to go for the moonshot, and so that there's liquidity for everybody. So how do you convince him to do that? Is I think one
Yeah.
thing, right?
Well, look, I'd say
And
this.
you
I mean,
can't convince him. I mean, it's up to him, right? At the end of the
well,
day, that's the thing.
correct, but here's a couple of arguments, right? Like, let's say, again, you know you're in a crowded space, and if you could wave a magic wand and say, okay, we can buy this data set or buy this company or even buy people who come in and really
Hmm.
help keep your race because you're in front of the race right now, but there's a lot of people running behind you.
Right.
Would you
Totally.
do that? And if you have to balance that with, well, we need profit because that's the only way that, we can, that's the only way we're going to make money, or we're trying to make money short term, which again is very valuable. Now, again, retention is uniquely great in that regard. I'd say most companies cannot follow your footsteps or would not be able to follow it as well. But if you're
Hmm.
kind of towing that line, it's very difficult to actually make those bets and investments that actually would put you out ahead. Whereas venture in a lot of ways is, it's almost like the purest form of risk capital, where if it goes well, then everybody wins. And then the other thing I'll say is, I've heard this before. The funny thing is, and people don't think of it this way often, but the most aligned people are employees and investors. Because as employees, especially where you've been told, hey, you're joining a startup, you're taking more risk, but look at all the upside. Um, Employees aren't being granted 5, 10, 20%. They're being granted 0.5%, 1%,
Mhm.
0.1%, especially as you grow, capital is very finite. There's only 100%. Um,
Yeah.
and as you grow and you're telling that story, you have an obligation to those people if you are, unless you're, if you're telling them that that is why they should join you, to take that shot. If not, you shouldn't be bringing on people. Now, separate discussion, that's where the company's going to run smaller and different models. And I
Right.
know firsthand just how uniquely good retention is, but most companies aren't. But they tell
Yeah,
the
yeah,
story. So are you
yeah,
taking
totally.
care of the people
And I
and
think,
doing what you're saying you're going to do? Because it is the only way. And look, if the world would be different, if companies IPO'd at 20 million in revenue, they don't.
right,
Only IPO at a certain scale. They only get bought really at a certain level where that equity, your 0.1% matters. And if you're going to tell that story to people, you have the responsibility to push for that.
right, right. No, look, if the VC was you, I would probably accept it because of trust and but you mentioned about investors being aligned to employees. I actually think they're not. That actually is one of my concerns because of
The
how
preferred
misaligned they
retirement
are.
and press stacks, definitely not
So,
there.
so yeah, exactly. So that's where I was going to, right? With
Right,
preference tax and with liquidity preference, and so
right.
what it does is, and then there's a lot more to it, right? The what it does is so, and there have been instances where a company gets sold for like 100 million or $200 million, and then the founders, and forget the employees, like nobody gets anything in common share, right? Or the founders walk away with just like 200K out of those deals. And so those are the ones.
Santosh, sorry, was that your number when you got that exit that you were talking
No,
about?
I didn't sell for 100
Sorry.
million.
No,
Well,
no.
and I
I
made
mean,
more than 200K.
I remember you telling that that there was a company you built. I think that wasn't the company that you said, but there was this company that you built, and then what you got was actually peanuts. That's when you decided to build your own because you were an
Yeah,
employee in
yeah.
that company.
Yeah, prior to the company I sold, I was working for this pharmaceutical company that got acquired by for like 250 million or so. But others made a lot of money. But the point I'm making, there are a lot of, I mean, that was a healthy acquisition, but there's a lot of acquisitions where, because of how it's structured, again, there are, it's just the way the game is played, and some of it, the founders are just novice. Uh, but those are, I think, that leave bad taste or kind of create risks for founders.
That
Mistrust.
How do you
easy argument
uh,
to that is again, it goes back to like, you know, do you want to play to win or play to stay alive, right? And I think the
mhm,
argument there is again, if you look at the generational and enduring companies, they've raised a lot of money, but then they've been worth more than that over time. And that's kind of that's the gambit. Now, and again, this comes back to I think some intellectual dishonesty on both sides because founders say they are because they want to get the yes,
right,
they want to get the money, and the VCs
right,
say we're not going to
Hmm.
fund you if our wallets are on the line, which of course they do. So
right,
there's a bit of I think
totally.
trust that is justified on both sides. Because yeah, I think that, but that's the game, right? It's like, hey, understand that this could backfire, but like, who's trying to make that happen? Are you trying to go for it or not?
No, this is, this goes back to the thing we started the call with, this George Akeroff's economic theory. When
Right.
there's information disparity, the bad actors
Yeah.
win. So it is intellectual dishonesty on both sides, and
It's the nature of
once
the
you get
beast, I
out
think.
of it, yeah, once you get step out of it, there's a lot of value in like VC as an asset class is here to stay, right? There's a ton of value to be provided. But you're spot on. It's the founders are intellectually dishonest about their goals and where they want to, and that contributes almost as much to this misaligned outcomes as VCs.
Definitely. I think, is there not a case for, raising some money for Santosh, and even if he doesn't go after the the $1 billion valuation or the IPO, and you can make secondary sales, and in the acquisition can make enough money for the VCs.
So that's the other part that's kind of misaligned with the VC math, right? But that would, talking about, say, retention, that would be a very good reason for retention to take capital if the outcome is not aligned to going IPO or billion, which kind of decreases the probability, right? But say the outcome is to do like a few 100 million sale in the next few years, right? Which is like a P type expectation deal, right? That seems the probability of that happening is very high anyway, and getting some investors to help with it would totally be welcome. But then that doesn't, and I'll let Amit kind of elaborate on it. But that doesn't work with the VC math, right? That's
Right. No, yeah, you're so right. And again, to Santosh's credit, he's said in a few ways, like, hey, if you have legitimate value, not like, oh, we have a fancy website and we, refer you to potential hires. Like, no, no, no. Real value, like your HubSpot, your NVIDIA. It's like, here's GPUs. I mean, there's real tangible value that it may make, or I'm gonna get you sold the PE because I am a PE or I work at a PE, something like that, where it's like, okay, there's a direct linear path to your value. Yeah, I give up percentage, or not me, but theoretically, some of those would give up a percentage of retention.com for that because it's a worthwhile bet and a high expected value to make. Now, to that point, though, I think your question is sort of more around, and again, I think that's probably more founders within a position of leverage should think about things versus kind of being sold on just generic VC stuff, especially at some scale. Maybe it's a little different when you're early
right,
on. But that's part of why you see a lot of successful angels and small funds like ours. It's like, hey, I can go get you an introduction to, HubSpot's exec team tomorrow, right? Or,
right,
and there's a lot of angels who are extremely networked and like they have more value than a 10-year-old VC firm that has a bunch of associates. Like they don't have any
totally,
specific value there. Whereas angels, if like imagine, especially if you're actively making something, there's stuff right there. And so that I'd say generally speaking, that's kind of how I think VC will continue to evolve towards because founders are smart and they're like, if I actually have leverage and people actually want to give me money, like why on earth wouldn't I pick the best weapons here, the best team versus just like
yeah,
whoever is good at selling, right? Now and distribute the cap table versus concentrating it all with one.
hmm
Maybe the same value with 10% versus 8% versus 5%.
hmm
Um, Now to your question about the model, yeah, I think at the heart of it, the biggest problem stems from what I mentioned earlier, which is that there's not enough paths to liquidity. Now in crypto, it's a whole different ball game. Things have maybe shown the other side of that. But I think generally speaking, if there are easier ways to monetize equity that aren't IPO or big dollar M&A, everything would be different. But because that is the only way, or those are the only real ways, um, for 90% of startups, um, things are, they're all reverse engineered for that. So if a VC invests, they're like, well, how, I'm only going to pick
right,
the audacious companies that have maybe even the slimmest chances of doing that versus backing a really fundamentally sound good business that doesn't want to do that. Because again, if you own 1% of something or 5% of something, just do the math, right? It doesn't work. Now, I do think there's a movement around, well, what if we do dividends and revenue? And I say this knowing that again, retention is uniquely great, but most companies are not like that. And let's
right,
take the example we said earlier. If you're making $1 million ARR,
yeah,
who's
of
making
course,
that money? If you own 1% of that, and then
yeah,
let's
that's
say
nothing,
let's say half of that is proportion for dividends, what you're doing is A, slowing down growth and potentials. You're
yeah,
basically taking yourself off the
totally,
track. And then there's not much money to be had from it.
yeah,
Assuming again that if you invest in 10 companies, 7 out of 10 are going to go to zero. So of
yeah,
those three, the pressure is like, well, where does the money come from? And I think
yeah,
so that is fundamentally the problem with the model. So I see a lot of founders and social media being like, raise one round and then go profitable and never raise again. As an investor, why would you do that deal?
that,
Unless
yeah,
you're highly
yeah,
profitable. Because if I were
Totally.
to put in money, risk capital, you can make more money buying Bitcoin. Like if I'm going to put in
Yeah.
money into this asset, it's going to be the only time they raise, and then there isn't a path to what Santosh has achieved. It's like nobody's making any money on that because they're off the exit track,
Yeah.
they're off IPO track. There's not that much profit to go around, and because for the founders, again, they own 80%. The VC owns 5%. So the math, it just is
That
fundamentally.
doesn't add up.
But
Yeah.
some of the point earlier, I think there's probably going to be more innovation around um, maybe more, and again, this is a very anti-founder thing to say, but it's kind of like people, if you want your investors should own more of the business, if you want them to align with different types of goals. If you want to basically squeeze on
Hmm.
cap table, all these other things, then people are going to basically optimize for exactly that, which is
Right.
you're not on track to IPO, I'm going to fire the founder because that's the
Hmm.
only way this is
Yeah.
now, so there's got to be some give in either direction if you want to take investment. Now, I do think, and again, this is not particularly founder friendly, but I wonder if there's going to be investors and founders who kind of say, look, I have a great point of view on getting this company to X stage, profitability wise or otherwise, and maybe we buy people out, we buy investors out
Yeah.
at a certain stage.
Yeah.
Again, if you're a founder, why would you sign up for that on day zero before you even have a product? Again, as an investor, you'd like
Hmm.
that. I think a lot of people would like that, but again, it's a lot to sign up for. And right now, you don't have to. Like, you don't have any
Hmm.
guarantee of anything if you take venture money, right? You don't have to grow at
Yeah.
all. You can just fail, and that's okay. So, there's something that has to
Yeah.
give
Let
for
me let me ask you something. Within the investments in the life cycle of a venture, do you think the seed investors or angel or early stage, they are at a higher disadvantage because their capital was more risky? They took on bigger burden than the folks that come up later in the cap table who have higher leverage, but then they end up getting a disproportionate part of their risk capital, right? So when a new model emerges, somehow I feel like the incentive should be more aligned to people that come
right.
in earlier than.
Yeah, and look, broadly, part of what I do like about venture, and part of why I like to do it is it's a beautiful form of like it's like innovation fuel, right? It's like, look, you're giving people money with no expectation of a return. I mean, that's unheard of. Like imagine
Mhm.
a loan or asking your parents for money. Like that's just not how
Right.
normal business is done. So the whole thing is risk capital, but when it works big. To your point, it really only works because you're right. It's not right. And, I'm very biased as an early stage investor, but yeah, it's pretty fucked up that a lot of times angels and seed investors, the ones who had to wait the longest, take the most risk, get squeezed by folks who then
Yeah.
come in at the
Right.
end.
And then there are all kinds of terms that get injected that kind of
Right.
is
And,
against them. And
canceling pro ratas. And
mhm.
honestly, I think
Yeah.
a lot of founders, are not, they're not being very honorable when they sort of don't protect those early
Right.
folks. Um,
Yeah.
again, they're sort of like, well, I'm, XYZ growth stage firm. They're making me do this. Like, look, founders can always fight for stuff if they want
Right.
the deal, but a lot of them just, they don't, but some do. But yeah, it is a pretty tough position. And so overall, especially as more people get into angel investing, which, it's a very kind of thankless thing. And I think it's very important though for the ecosystem. Like I said earlier,
Yeah.
people have to make money from it. If they don't, they're going to stop doing it. It's very simple, no
Yeah.
matter how much money you have. And so as these
Totally.
things happen, I hope that there's easier ways for people to realize liquidity through secondary marketplaces, through, being protected more by founders, through being bought out, other things like that. I think it's just net positives because that money usually gets recycled back into startups anyway.
Hmm.
Uh, and so, yeah, to your point, I think, look, the upside is very simple. The upside is that, you're never going to get 1,000x investment if you invest at Series C. You
Right.
could at C or pre-seed. So the upside is the highest, even with dilution for those early people. But yeah, a lot of the kind of dealings that happen later on through a company's winding journey, unfortunately, do put the early stage investors who do not, they deserve maybe the best treatment. Somehow they get lesser. But, and but by the way, same thing applies to common holders and employees as well.
Just to sum it up, that section now, Santosh, are you convinced to take his money or not?
Well, if it is Amit, I'm convinced he brings a lot of value. I will take his money any day. And he can, in general, um, we don't have to take VC money to grow or
Yeah.
fuel yes, we'll not grow. I don't think we have aspirations to go to IPO just as a team. But the dreams we have, we feel like are the way we are growing, we can get to those dreams. But I'm convinced Amit does bring a lot of value, including connections and advice. And every time I talk to him, he makes sense.
Amit, your call.
That's very kind of you. I don't think I'd let you take the money, but I don't think you need it. But no, I mean, yeah, retention is it's a company to aspire to. I think, I mean, RBB and retention, there's no question that, and I can say this too, so many people in my network that I talk to as second time founders, so they've been through this dance, they've been through the game, VC backed, even with successful exits and gone well. Some have gotten back on the horse and said, okay, this is the way to build a company. It's worked for me. And this is the way to, again, dream big and I can do it. It's easy for me because I have brand. But so many folks are aspiring to be like retention, saying, look, I can do it a different way. I can be much more clever around distribution than kind of the old playbook that's sort of generally VC serving. And so I think more and more and more A plus 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 people are going to follow that route, where historically they maybe haven't.
It's a good way
And
to
yes,
summarize.
and that's not great news for VCs, by the way.
Yeah, yeah. That's what
No,
I was about to say. Not great news, but yes, I think
It's
now
really
you do
not.
conclude you are happy for retention.com, but even if they don't take the money. So best wishes to you, Santosh, and maybe if you change your mind and you do take the money, do credit us a bit, okay, because of this
will do.
conversation.
Thank you.
So
Well,
guys, on
Dayton,
a
Dayton, I want to say this. One thing that's important to say.
yeah,
I know this is part of, your podcast and the brand, but nothing is further than the truth for like a company thinking that success is raising money,
Hmm.
right? I'm sure you've seen this before, but it's like raising money is an obligation, not a accomplishment. And it can feel like that. And again, I think a lot of the a lot of the culture of like celebration around funding is very much not by accident, because that is, if you're a VC, you want people to celebrate that because it rewards
yeah,
them for that. But so this idea of like, well, we need to go to the US to raise funding, we need to do this to raise funding. It's like that's not the objective function. The objective function should be customers and building something people want. And as Santosh said, there's no easier way to do that. There's so many ways to do that now that have absolutely nothing to do with raising VC money. And this idea that it should be celebrated. I mean, ask any founder, they're going to say it's a tool. Funding is a
yeah.
tool, same way that LMs are a tool. And I think it irritates me a little bit that, yeah, a lot of the culture, again, this is against my own self-interest, that a lot of people then have been conditioned to think that I want to start a company. Well, all right, how do I get to my first funding milestone? It's like, why? You don't have
Yeah.
to. You don't have to in the same way.
Just gonna use the last 5-7 minutes if you guys are okay. Which obviously we had a lot to cover, but I think we need a part two of this. You guys have
Sure.
dropped really good stuff today. But I know I wanted to know a little bit about your personal life too, and that's just because people should know, and that's always something I do in my podcast. Give a flavor of your personal life. And I could have asked you a song for both of you and played it. I'm gonna ask one of you to play and send me a song or give me a song so I can play it, and one of you can talk about the latest book you are reading. I see some books behind Santosh. If you want to talk about that while we play the song that maybe Amit can give, what you're listening to these days, Amit.
Oh man, I love music. I listen to music all the time, constantly. If I'm not on a call, I'm basically always listening to something. What have I listened to lately? I saw a recent a documentary about Tom Petty that was previously unreleased, and he's one of my favorite older artists. So I guess plug for
You
a
just
incredible album from 1991, Into the Great Wide Open. Phenomenal. That's what I've been listening to lately.
what is it called?
Well, the album is Into the Great Wide Open, but I'd say Learning to
Great Wide
Fly.
Open.
Learning to Fly is probably the most famous song off that record. And he was one of the most famous U.S. rock artists, probably in the 70s, 80s, 90s. I guess probably most of the 80s. So he's pretty well known and operating the Heartbreakers. Um,
Oh,
but so yeah, I guess I've before I was even born, but definitely followed him for a long time. Still do.
Yeah, that's one thing that I'll probably go and listen to, because I think
Great
this
album.
whole genre is dying now. I mean, I don't see a lot of artists coming and just giving this vibe of this sort of songs.
Yeah, and do
So
me a favor, listen to the entire album, Into the Great Wide Open. I think
yeah,
full albums were more of an art. Uh, that's a great experience.
yeah, I'll do that. What about you, Santosh? I know you have some books behind you. We can
Yeah,
talk
yeah.
about that.
So yeah, I read business books a lot, especially growth, because I'm just intellectually curious. I think it's like the way I look at it is, um, that every generation writes their own book, right?
Yeah,
Writes their own stories. Similarly, they buy and sell their own way, right? And there's like new go-to-market strategy that evolves every five
Yeah,
years, every 3 years, right? It's easy to fall like become complacent and not keep up with it, which most companies do, right? They keep selling the way they sold 10 years ago. Yeah,
yeah.
I love just staying up to date.
Yeah, reading is very important for sure. I think long form. I just picked up this book yesterday from Indigo.
Yeah,
I don't know if you heard about this guy.
yeah,
I
yeah.
think it's a part two. So
I
I'm
see.
looking forward to read. I haven't read it, but I've kept it so I can show
Nice.
off that I'm gonna read this. But yes, that's something that I'm gonna do, because even I like nonfiction more, even though I've read fiction before. But it's just something that you need to read just to be ahead of the game, I think.
There's a lot going on. We are living through times of transition and change.
Absolutely.
It's good to stay ahead and catch
Absolutely.
up.
No, this was great to catch up with both of you. I think we spoke separately before we got into the call, but I was not expecting that we'll also come up with really good insights today and a lot more that we didn't know we'll cover. So, and I think Amit led the way. He started the conversation with a great news. So, congratulations again on that featured list, the listicle that he talked about.
I guarantee everybody on that list is going to be bombarded by VCs in the next, if they haven't already. Hmm.
Are you going to reach out to some of them?
No, we're super early. I think for the ship's probably sailed on
Yeah.
those for
Yeah.
us. And but
Yeah.
look, if I was doing later stage stuff, certainly that wouldn't be a worse place. There'd be better place. There could be worse places to look for sure.
For sure. Now, great guys. I think this was a great conversation. Thank you again, Santosh, for setting this up. And you had to put Amit on it. And Amit played a good sport today. I think very, very good conversations, good arguments, I would say. We didn't cover some of it, but I think we covered a lot of other stuff that was important. So I'm very thankful to both of you. And thanks everyone who watched this for tuning in. Hope to get more of these reverse pitches soon. Thank you guys for watching in and stay tuned. Bye bye. Take care, Santosh. Take care, Amit.
All right, thank you so much.
Cheers.
Thanks, everyone.